Good morning from Dublin. And thank you, Derek, for chairing. Thank you, Karen, for helping to organize these sessions. And also thank you to Lisa and Regional Studies Association for having us. I'm Martin Sokol in Trinity College Dublin, and I'm presenting a joint paper with two of my colleagues, Rodrigo Fernandez and Leonardo Pataccini. And our paper is entitled Financialisation, Post-Pandemic Central Banking and Urban and Regional Recovery, a Turning Point for Monetary Policy. And I would like to say from the start that this is very much work in progress, and therefore we welcome your comments and suggestions. Now, I would like to start by outlining key points from our presentation, and it is as follows. The first is that we believe that central banking is a kind of a blind spot of urban and regional studies and partly of financial geography as well. And we believe this is problematic because in these pandemic times, the power of central banks have increased dramatically. And at the same time, simultaneously, urban and regional inequalities are likely to rise sharply. So when talking about urban and regional recovery, which is the main theme of this conference, we believe this will be impossible without a supporting monetary policy, which in case of Europe is, of course, the ECB. And we therefore would like to underline the point that spatial impacts of central bank interventions require urgent scrutiny by financial geographers and other scholars. So I would like to start by outlining the evolution of central bank power in the last couple of decades, how we got here. So we know that since 1980s, as Daniela Gabor calls it, it was the end of the big fiscal state, which came with the separation of monetary and fiscal authority. So we have the central bank independence, basically governments giving up control of central banks. And of course, what central banks did with this new independent power was a monetary policy that was dedicated to fighting inflation, mostly via, of course, interest rates modifications. By doing this, central banks have basically constrained governments in their spending, while at the same time supporting financialization and more specifically supporting financial markets and more broadly financial capital. Now, this, of course, as we know, led to the global financial crisis, which, let's not forget, has itself serious implications for uneven development and spatial inequalities. So the global financial crisis then, of course, was a kind of major watershed in terms of central banking, and we entered what Daniela Gabor called shadow monetary financing regime. So here in the post-crisis environment, the interest rate cuts were simply not enough to revive the economy. And so central banks started implementing unconventional policies, in particular quantitative easing, as well as using conventional policies in unconventional ways, as Tuori called it. And this involved all major central banks, the Federal Reserve in the US, the European Central Bank, the Bank of England, etc. And I don't think it's an exaggeration to say that without these central bank interventions, the system back in 2007, 2008 would have probably collapsed. And what's important to realize here is that the monetary financing that Daniel Gabor is talking about, I would call it indirect monetary financing, because the quantitative easing that was unleashed back then was in in good measure was obviously buying up government bonds. So it's we call this indirect monetary financing. Now, this graph shows just how much the central banks now, in the aftermath of the global financial crisis, how much they own basically the sovereign debt, and you can see the dramatic increase following 2008 global financial crisis. So, but if this was a dramatic development, it's nothing in comparison to what happened when we hit the pandemic in 2020. So the development has been described by David McWilliams, an Irish economist, as a monetary revolution of seismic proportions. And also Daniel Agaber is talking about a revolution in central banking, although a revolution without revolutionaries. And what we have here is that it appears that the quantitative easing that has been tried and tested a decade previously has now been unleashed in unlimited fashion. So trillions of dollars have been injected into the economy to prevent it from collapsing, or should I say better, financial markets to prevent them from collapsing. And so, 6 trillion alone for G10 economies in the first few months of the pandemic. By April 2021, the IMF estimated that about $10 trillion have been injected into the system. And the Fed, of course, has been a kind of a prime suspect in this. It has been estimated that about by 2023, about $9 trillion will be injected into the system by the Fed, which amounts to staggering almost 40% of the US GDP. So this is no small beer. And this graph from Bloomberg shows the scale of the pandemic response in comparison to quantitative easing a decade earlier. And we are really into trillions here that have been used by central banks to prevent financial collapse. So much so that in the US, Jackson argued that the US is not a country with a central bank, but it's a central bank with a country, and highlighted also the fact that at the height of the pandemic crisis, the Fed was basically injecting some $1 million into the system every second. So the question, of course, is, can financialized capitalism survive without these interventions? Now, my short answer will be probably no, because if you look at the flow of finance and something that we call in my team financial chains, in the financialized economy, central banks are absolutely crucial element, and the only element that in a situation like pandemic can actually act to prevent the system from collapsing. And of course, all this has implications for economic geographies and city regions involved, because all these kind of flows are interlinked and have their geographies. Now, what we have today, therefore, is that the central banks have dramatically, through this crisis, dramatically increased their power, and they are operating now with a wide range of interventions. So, of course, interest rate is a traditional one, but of course, there's central banks also lend to commercial banks. That comes usually with central bank reserve policy. Also, central banks lend to each other. Some central banks are allowed to lend to their own governments, others are not. Asset purchases or quantitative easing is obviously the main new instrument that is being used with vengeance. And of course, central banks usually have a regulatory role, and believe it or not, and also influence things by signaling, kind of soft power. So all these interventions are being used now. And of course, under discussion, this may go further. And under discussion, there's like potential interventions. So, for example, direct lending to firms and households, sometimes linked to the debate about central bank digital currency. And also, of course, the proponents of the modern monetary theory would like to see what I would call direct monetary financing, which is the creation of money by central banks passing on to the government without actually creating any debt whatsoever. So, but the point in our presentations we want to make is that all these interventions have spatial effects, and they have spatial effects both within and beyond the monetary zone, where these central banks are operating. So this is a crucial thing. And in case of Europe, of course, what the ECB does have effect not only within the Eurozone, but also well beyond the boundaries of the Eurozone. So what we have in case of Europe is an extremely complex monetary space, actually. We have, of course, the European Union, but the Eurozone covers only part of the member states of the European Union. So that Eurozone, of course, it has the European core, economic core in its middle, dominated by Germany. At the other end, there is a southern periphery, and then we have, varieties of eastern peripheries, some of which are completely in the Eurozone, some of which are partially in the Eurozone, some of which are outside the Eurozone. And we also have now, of course, the fortress UK outside the EU, and we have outer peripheries that, of course, are influenced by what's happening in the Eurozone. So if ECB does something, the impact is, of course, within the Eurozone, and the impact may be different for the core economies like Germany, and different for the southern periphery of the EU. The impact may go well beyond the Eurozone into other EU member member countries. And of course, there may be spillovers well beyond the EU, of course, into outer peripheries and further afield, global south, etc., etc. So what we have here is a kind of a complex situation, really. And obviously, this presentation is not going to pay any justice to unravel all these implications. But I would like to just try to highlight, as a kind of a taster, as a few examples of mechanisms through which central bank interventions that I mentioned have spatial effects. And I would like to start by the one that is most unlikely candidate to have any impact at all, which is the signaling. And this is just the power of words, really. And my favorite example, of course, is Madame Lagarde's infamous statement in the press conference in the early days of the pandemic that we are not here to close spreads. This is in the situation when the government bonds of Italy were obviously getting dramatically different pricing than the German bonds. So this one sentence of 7 words has been estimated by critics that the potential cost to Italy and its taxpayers is about 14 billion for the next decade, which is 2 billion per word. Potentially the most expensive sentence in the history. Of course, Madame Lagarde backpedaled very quickly from this statement, but the damage partially has already been done. Now, the other example I want to highlight is the interest rate, which of course, is the traditional tool that central banks have at their disposal. Although in today's kind of ultra low interest rate territory, the policy is fairly ineffective in many ways, but still has massive implications for uneven economic development and for regions and cities. So this is because we, of course, know that inflation has strong regional variations. In particular, there's a massive difference between booming regions and contracting regions. And therefore, one size monetary policy based on interest rate does not fit all, as has been highlighted by fellow kind of economic geographers long time ago. Also, what is happening is that interest rates set by the central bank, of course, have implications for that currency's exchange rate vis-a-vis other currencies. So this is, of course, affecting imports and exports, and these are not abstract categories. There are, of course, importing and exporting sectors that are differently affected by this. And these sectors are in some regions, and so the impact, of course, is spatial and regional, as, for example, Vermeeren in the EU context have shown. The other example I want to highlight is, of course, the asset purchases by the central bank. One of the main tools that are employing now through quantitative easing. And this, of course, has been extremely controversial. Some people believe that quantitative easing is not working. But I would say that's not correct. It is working for some, clearly. So there's a big debate on what's called distributional effects of the quantitative easing. Of course, the mechanism for which this is happening is, one of them is actually interest rates, because the QE normally depresses interest rates. So it kind of further benefits debtors and disadvantages savers, which is a typical German complaint about the QE, and the one that it made it to the German Constitutional Court, as we know. The other side, however, of the QE is that it inflates asset prices by these kind of massive purchases of assets, which of course benefits asset owners. And we know very well that the asset ownership in the financialized economy is highly unequal. So who benefits from it is a major question. And some would ask whether QE, in fact, is not a subsidy for the rich and for the financial sector. And then, of course, it should be remembered, as I mentioned earlier, a lot of this asset purchasing is spent on buying up by central banks of government bonds. And obviously, this has additional and important spatial dimension that should not be forgotten. So all this has implications spatially at various scales, including urban and regional scale. Finally, I would like to very quickly mention lending to banks, which in Europe is an important element of what the central bank is doing. This is called refinancing operations, and with that obviously goes collateral policy on the conditions under which the central bank is lending to commercial banks. And here I won't give you any clues. I'll just point you to this wonderful paper by Klaus Tuori, who kind of raises a question like, is this and other ECB policies basically a hidden transfer mechanism? Is this a subsidy for banks? And from the spatial point of view, the important question, of course, is this a subsidy for banks from certain countries? So I'll leave you in suspense there, and please have a look at that paper for answers. It's of course more complicated than it seems. Okay, so what I have been spending my time in recent days and weeks and months is to try to put this somehow together and see how the central bank interventions are influencing the flow of finance within the economy, and what really are effects of these unconventional kind of policies. But this is still very much work in progress, as my colleagues Rodrigo and Leonardo know, so I won't go into that. All I say is that watch this space, and I hope that I will be able to tell you more about this in a presentation at the next event. So with that, I would like to just to reemphasize a couple of points as a way of conclusion. There is a growing debate now about the remit of central banks, and this debate focuses on social effects such as employment and inequality, issues, for example, highlighted by Brown and Jackson and many others, and increasingly also the kind of environmental effects of central banking and monetary policy, and to what extent central banks should support green transition, as again kind of underpinned by a growing number of contributions from academics and experts. But what we would like to argue is that spatial effects of central banking are often overlooked, and they do need to be put on the agenda. In fact, if we are to have an urban and regional recovery post-pandemic, we believe this will be impossible without a supporting monetary policy that will take care of regional and urban economies. And with that, I believe my time is up. So I stop here. Thank you very much. And I'm looking forward to your comments and questions in the section for comments and questions. Thank you.